All right, well, it's time for questions. Let's start with this one. The first one is increase in interest rates can put the brakes on the economy. That is for sure. Interest rates, when it's at the Fed level, when the Federal Reserve raises interest rates, there's only one reason, and that is to slow down the economy. The Federal Reserve is not planning on, or at least has stated it's not planning on raising rates. So we don't have that so much to worry about. Mortgage rates, that's more tied to fear in the economy or confidence. If there's fear, more investors buy mortgage-backed securities, and because it tends to be a safe place to put your money. And in that case, interest rates or mortgage rates can go down. When there's a lot of confidence in the economy, more people put their money in the stock market and less into mortgage-backed securities. And then because there's less demand, then rates go up. There's more belief that we're sort of in this in-between place where people are neither confident or fearful. They're just it's a lot of moderate, a whole lot of moderate. So most of the economists that I've been interviewing on the Real Wealth Show do not think that interest rates will go up, at least not over the next few years. They will eventually, which is why it's great to lock them in now at these low rates. Next comment, the government can just print money and individuals cannot print money. Yeah, super unfair. It is a hoax, really, and it's never been tested, or maybe it has been tested, but it's something to definitely be aware of, that we're in a time that the government can just print money, they can sell treasuries, and there's no controls over that, so politicians can kind of get what they want, and their constituents as well. So, but somebody has to pay for it, and that's what nobody really understands yet, how that's going to happen. Who's going to pay for it? As we know, when there's a bigger gap between the rich and the poor, then there's usually a war on the rich, and that's kind of what we're seeing. So kind of a sentiment out there that it's the wealthy who cause the problem, so they're going to need to fix it by paying 90% of their income towards taxes. That's not going to happen. That's not going to happen. The wealthy are the ones who have the ability to leave this country if they want to. They can move. That's why we're building a whole retreat center in Costa Rica and a community there for people who maybe have just had enough, who have worked hard all their lives, have built companies and don't want to only make 10% of their income, paying 90% to the government for things that they didn't get to choose. So it's, you're right, that the government can just print money. That's just since the 70s when we went off the gold standard, and that's not very sustainable. And it's certainly something I'm concerned about. And one of the reasons why is the more fake money that's printed, in my opinion, the more valuable are the hard assets, because money becomes cheaper the more of it you make, but the value of assets goes up, and that's what we've seen over the years. Home prices have gone up, stocks have gone up, because the dollar just doesn't go as far when there's more of it in circulation. So when you have hard assets like real estate and gold, they tend to go up in value when the government's just printing money, as we know, and we've seen in other economies that have had hyperinflation. So again, it's a way to look at, it's a way to hedge that potential inflation that could come from all this money printing, is having hard assets like real estate that do tend to go up in value with inflation. Hoping you guys get to this, but wondering if you folks listen to Robert Kiyosaki. He has his own opinions concerning the next crash, saying that the big reason it will happen and be so destructive is that pension programs are going broke. Do you agree with this as well as other factors? Absolutely. This is I didn't put that in this presentation. I think I'll put it in the one for our January event. I've talked about it in the past before, but I would tired of being the voice of doom and gloom and trying to find the bright spots in the economy. But yeah, there's going to be a massive pension problem. There already is one in a lot of different states, and certainly we're seeing it in the Chicago area. They don't know how they're going to pay their pensions. It's all in line with this belief that the government can take care of you, that it has unlimited amounts of money, and that rich people have unlimited amounts of money to pay for everybody else. That's the sentiment that is going to destroy this country if it continues, because it's not what our country was built on, which is you have this opportunity to create wealth in America. You have opportunities like no other country. It's not a place you come to just be given to. It's a place where you can come to create. But those founding beliefs are not not really in existence today. Um, so many pension programs were very, very generous, uh, with no idea, no real plan for how they're going to get paid out. So it's really sad for people who've worked all their lives and may not receive those pensions. It's very, very sad, very destructive, and a good reason why many of us are looking at different ways to build wealth outside of the normal system. And so with real estate, of course, the question is, wow, if a bunch of people aren't getting their pensions, how are they going to afford to rent? This is again why it's so important that if you're buying rental property, that you do it in places where there's job growth and population growth, so you have a huge pool of renters to choose from. And if you stay within that affordable range and ideally below, just slightly below the average, uh, you know, home price of the area, and the average income, if your rents are below what the average person can pay, you should be able to ride through any recession. Just like in 2008, it was Robert Kiyosaki who gave me the advice in 2005 when he was on the Real Wealth Show to sell all of California holdings because of the bubble, because bubble due to bad debt, and get into Texas where the home prices were lower and they were not in a bubble, and there was massive job growth and population growth. So he found this incredible opportunity to sell at the peak in California in 2005 and 2006 and 1031 exchange to properties in Dallas that where the population was going, where the job growth was going, but the home prices were in line. We're actually 27% undervalued. So that, it's not like he pulled all of his money out of the market and just sat in cash, fear of what he knew was coming. He repositioned himself to be able to ride right through it. And fortunately, he was on the Real Wealth Show, so I learned from that, and that's how Real Wealth Network actually started, was because of Kiyosaki. So I'm a big fan. I've learned so much from him, and it is not a time to be fearful. It's a time to make sure you're positioned for a potential storm, that you can ride it out. So those of us who did sell our California properties and buy in Texas, most of those people didn't feel the recession at all. They, let's say I had one woman who sold one property in San Francisco and bought 20 elsewhere. Can you imagine that? It was like a $1.6 million sale in California of kind of a dumpy property, and we helped her get into 20 elsewhere, and those are diversified across the country. So instead of having one rent and potentially one person who doesn't pay the rent, or that you have to evict, or she diversified into 20 properties in different markets, 20 different people that if half of her portfolio went vacant, so 10 homes went vacant, which is very unlikely, she's still making more money on the 10 that are rented than if she had that one property. So it really is a time to position yourself for the potential of a crash, a potential of people not getting their pensions, of potentially taxes going up. But you can tax shelter through real estate. So if we just use 2008 as an example, again, those who sold their bubble properties and got into areas where there was job growth and population growth, all they saw were rents going up. All they saw was they got a raise during that recession, because every year rents would go up because there was more people who lost their homes and needed to rent. SFR rental fund, can you talk about the business model behind this? That sentence didn't get finished. We do have a single family rental fund, but it is closed. So I don't know if that's what you're talking about, or if you're, let's see, maybe, okay, there it is. Can you talk about the business model behind the fund, also who to reach out to get more details? I don't know if you're in the fund already. If you're in it, then you would just get your quarterly updates or reach out to syndications at Real Wealth Network. If you're not in it, it's not open. So we're considering doing another one, but haven't at this time. Which markets are a good balance between price appreciation and cash flow? Very good question. See, I don't have the ability to show my slides and look at the questions for some reason. I don't know why that is, but basically when you follow the jobs, follow the population growth, and you get into areas where properties are still very much in line with salaries. So for example, you can buy brand new homes in Orlando or Atlanta for around $200,000 or less. And generally speaking, the income should be about a third of that. So if you're buying a $200,000 home, the average income of the area should be about a third. And that is the case in those areas. So jobs, salaries are in line with home prices. So it's a very unlikely that you would see a collapse in those markets, even if things slow down. But on the flip side, we know that things are speeding up. That's where jobs are going. That's where the population is going. And yet you could still buy brand new homes for under $200,000. It's incredible. So we are just, like always, following the jobs, following the demographics, and going to areas that have not popped yet. So just like when we went into Dallas, now everybody knows Dallas has been a hot market, but 10 years ago when we were going, it wasn't. It was a super boring market, and people would laugh at us. They thought we were crazy, that we would leave California where prices were going up 10 to 20% every year and go to a flat market like Texas where they weren't going up at all. I'm telling you, people thought we were absolutely nuts. But what we trusted was what Kiyosaki said exactly, which was follow the jobs, follow the population growth, and affordability. If you're able to get those three things together and then add the fourth one, which is infrastructure growth. If you can get into an area where the city is investing itself, putting in freeways, putting in new schools, new businesses coming in, you're seeing cranes everywhere to keep up with the growth, then but all of those other things are in line where the home prices haven't caught up yet, there's a pretty good chance you'll get appreciation in the future and cash flow today. But the most important thing is to look for the cash flow. Make sure you've got plenty of cash flow in the properties you buy, and that appreciation is always, it's never guaranteed, but if those elements are in place, it's probably going to happen. Again, population growth, job growth, affordability, and then that fourth one of infrastructure growth. Do we have any good property managers in Texas? I think it's Atlanta or Florida who can help in buying, renting, and managing properties. That is what we do at Real Wealth Network. So kind of I'll explain how we got started. In 2003, Rich and I were really looking for a way to create passive income, and I was lucky enough to have people like Robert Kiyosaki on the show to explain, their strategies and so forth. So when Kiyosaki said he was selling all of his California properties and buying in Texas, the first thing I did was get on a plane and go to Texas to find out what was going on in that market. And I met with property managers all over Dallas to find out where the job growth was, where the rental demand was, where the infrastructure growth was. And we ended up landing on Rockwall, Texas, because there was a new freeway coming in. There were A-rated schools. We could buy brand new homes for $120,000. It all just made sense. So we bought, I think, 7 properties there. And Rockwall. Came home, I talked about it on the Real Well show, and I had just the phones ringing off the hook of people saying, oh my gosh, can we use your team? Can we use the property manager you're using and the realtor that helped you? And I said, certainly. So we shared the information, and that's what we do today still. We're looking for the areas that have the strongest job growth, population growth, and have really good teams there who can help you buy and help you manage it. You just need to be a member of Real Wealth Network. You join, it's free, and then ideally meet with an investment counselor so they can help you really hone in on which market's best for you. And then they would make that referral to the team that's over there. And the people that are on our referral list have a track record with us. Otherwise, they get taken off the list. But at the same time, you still need to do your due diligence, always get your inspections, always get your appraisals, because even if a team's been really good for the past 10 years, you never know, staff can change, things can change. So it's really always important that you you stay on top of it. Because like I said in the beginning, it's your ship, you're the captain of it, it's your money. Make sure you always do your own due diligence. Okay, thinking of an exit strategy, say in 20 years, what type of house will be easier to sell at that point? I've heard $70,000 homes are not as easy to sell as $120,000 homes. Well, it just depends on the market. You won't find a $70,000 or $120,000 home in California very easily anyway. But you know, in parts of Detroit, $120,000 would be a pretty nice home, and you could still get something in the 70 range. And but the I would say a rule of thumb would be that if you stay within the average home price of the area, remember an average home price is the properties that are selling the most. That's why they're the average. That's why that's probably got the most demand. So if you really stick close to the average home price of the area and maybe slightly under it, I prefer to be slightly under it, then you shouldn't have too much time, too difficult of a time selling it. Long as there's job growth and population growth. Now, 20 years is a long time for an exit strategy. So I want to be really clear that nobody knows what's going to be happening in 20 years. That's difficult to forecast. Try to imagine in 2000 knowing what 2020 would be like. That would have been really difficult to do. Think of all the things that have transpired in the last 20 years. All the technology that's come online. I mean, we didn't have Airbnb. We didn't even really have computers. People weren't, we didn't have iPads. I mean, there's so much has changed. To try to project what the world will be like in 20 years is pretty tough, but I can assure you it will be nothing like today. Absolutely nothing like today. So it's more important than ever that you stay on top of your investments, that you really pay attention, because every year there's going to be massive, massive changes like we've never seen in the past due to the advances in technology. We've never seen these kind of advances in technology before. So I would really have your exit strategy be thinking more 5 to 7 years, maybe 10, because again, we don't know. Even in 10 years, it's been pretty well documented that we will probably be flying our cars. That would change a lot of things, right? It's very possible that people will be going to school at home through their, uh, what am I trying to say? Through, some of the technologies that are available today, people might not even have to go to school anymore. So just know that the world will not be the same place, probably even in 10 years, let alone 20. So again, I would say, really, when making decisions, think about the next 5 to 7 years. Make sure you have a good exit strategy. In 5 to 7 years, you might say, hey, this asset's really working great, I'm going to keep it. Or you might say, maybe it's a good time to sell this and get into something else. I know that a lot of people who bought in Texas kind of followed our advice and bought in Texas 10 years ago. They're selling today because they have so much equity. They're going into other markets where they can get better cash flow. I mean, 10 years ago, Texas is where we were going for cash flow. It's not as good today. So it doesn't make as much sense. It might make more sense for people who bought 10 years ago to sell it and go buy somewhere else where there's even higher cash flow. So anyway, again, just have a shorter term strategy as an exit and pay attention to all the changes that are coming over the next years. Do we still get properties at $100,000 in these areas? There are some areas where you can still get properties for $100,000. It's getting harder and harder to do for sure. I'm going to say most of the areas are closer to 120. They're bouncing back to where they were in Texas and Dallas. And Ohio, you can definitely get into that price range. It's a different play. We're not seeing the massive job and population growth in Ohio and in Michigan, but what we are seeing are really low prices and some growth, kind of steady growth. So if you're really looking for cash flow and not as concerned about the value of the price going up, you really might want to look at the Midwest, anywhere from Kansas to Missouri to Ohio, even Chicago. I mean, these are areas where you might not see massive growth, but you would see cash flow. Now, Chicago, again, you have to be careful of the pension problem. That's going to be an ongoing problem, but you can buy in the outskirts. So yes, there are areas that are around the $100,000 range. If you're getting a new home, like in Florida or Atlanta, it's going to be, I mean, it could be as high as 200,000.